Who let the dogs out? Woo. All right, so today we are talking about North Star Acquisition Corp. It is a SPAC, and they're merging with BarkBox. The ticker of currently for Northern Star Acquisition Corp is STIC/U because it's the warrants. The stock should be trading in the coming days, and when they successfully complete their merger with BarkBox, it will be Bark stock. Woo, woo, woo. So what makes this interesting? So it's a company that's growing over 60%. So a fast grower. And in one scenario, based on, management's outlook for the years ahead, their growth plans, this stock could potentially go up 200%. Let's say based on that, their outlook. And we'll get into that in the valuation at the end of this video. And I'm going to go into all these different components. So at the end of the day, you have the SPAC, $2 billion valuation for BarkBox approximately, fast growing company, potentially a lot of upside if they deliver. So this video goes out to all my Unrivaled Investing Journey subscribers and a bit about that, a 10-second plug, if you will. So you are watching Unrivaled Investing. My name is Daniel. This is a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. So if you're interested in learning about potential multi-baggers, make sure you subscribe if you're already a subscriber. I really do appreciate that thumbs up. And if you want to follow my personal journey to try to find multi-baggers, the types of companies that can go up hundreds or even thousands of percent over time, go to unrivaledinvesting.com to see what I'm buying. What are the potential multi-baggers that I'm following? What's in my portfolio that has already gone up a few 100%. So let's dig into BarkBox. What is the deal? What's the deal here? So you have the current SPAC, which is under the ticker STIC, STIC/U for the units, because that's the predominant thing that's trading at this point. It'll be turning into Bark. It's actually a relatively clean and simple deal, where you've got about $250 million in cash from the SPAC, an upsized PIPE, so private placement, which was originally supposed to be $100 million, got bumped up to $200 million because people are pumped in this environment. It is full on 100% grade A greed that you have going on here. So people are like, cannot get enough of these deals. So bump up the PIPE, at least that's according to management. They had to bump up the size. So all in a little under $500 million. It's all going to the balance sheet, which is what I like to see. Balance sheet and fees. Fees, look, that's how the game's played. Bankers got to get paid. But the going to the balance sheet is what I like to see. You can see the implied equity values a little around $2 billion. Then you have this $490 on the balance sheet, less some debt. The implied enterprise value of $1.6 billion. But the market cap, the equity value is $2 billion. And you can see who's getting the stock with the SPAC founders getting a nice 3% for just doing the deal. And that's part of the reason why this machine keeps going. The founders, they get 3% of a company that's worth over $1 billion just for doing the deal. And so all in, you're looking at fully diluted shares, a little over 200 million fully diluted shares. And thank you for laying out the share count. It has been very confusing for a lot of people. I think I should do a video on like skills, which has confused a lot of people on what's their actual market cap, because you have to sort of dig through the filings to find out what the share count is. So what is BarkBox? So it is a direct-to-consumer brand aiming to be like the dog brand. Not cats, no cats allowed. This is exclusively canine unit here. And the subscriptions generally range from 23 on up. Depends on, how you're pricing it. Is it a one-time deal? Or are you sort of getting multi-month sort of offerings? 87% of their revenue is recurring in nature. So you do have these sort of one-time sales, but that is insignificant relative to the nature of this business. This is a subscription business. Nearly 90% of their revenue is subscription in nature. So when you're thinking about that business, BarkBox, you should think that does contribute to what the potential valuation could be. You do need to think about that. And you can see what it is. You get these plush. Here it is under the Peanuts brand. You get these plush toys, $60 in value, delicious beef, free bonus toy every month. Give your dog exactly what they want, because your dog has always wanted the Peanuts snack bag. I mean, What dog hasn't? What dog doesn't know about the Peanuts branded snacks? Come on. So it's an omni-channel brand. That is an important aspect to consider here because they have a presence selling their toys, their Bark toys, their Bark snacks inside. So they have their foot in the door in 23,000 retail locations. The CVS, the Costco's, the PetSmarts, the Walmarts of the world. And consumers love it. You know, they're talking about having an NPS score of 70. I mean, that is a strong brand. That is like an Apple or a Tesla where your consumers are like, we love you. You know, like we are going to recommend others try it for their pets. 170 million unique BarkPost visitors. And you can see how they're, by constantly offering new products, that they're expanding their addressable market. They're going into bigger and bigger markets. Oh, you start off with the normal Bark box. Oh, now we move into dental and then we do eating, and you're just increasing your market size over time. And you know, so this is what you could see of their subscription business over time. And during COVID, there's been a 20% increase in households with dogs. That's huge. I didn't realize it was that big. So when you're looking at these numbers, you do have to sort of discount it a little bit because that is an incredible tailwind. People are lonely. People want their best friend to be at home with them, their new best friend. But still, you're looking at 60%, you know, Bark active subscription growth from 663,000 to 1 million subscribers, over 1 million subscribers. And they're saying they currently have 1.1 million active subscribers. So there's a chance their fiscal years are off by a little bit because they use March end of year. So this is fiscal 21. So good chance that they beat that because they're currently at 1.1 is what they're saying. You know, 6.5 million Bark customers. I think that's a combination of churned customers and the folks that are going to, let's say, the stores, going to Costco and buying a Bark product. But still, this is pretty strong growth. And once again, they're looking to be the global brand for dogs. And it's an interesting aspect. Like, hey, we're going to be the exclusive player. We're going to be the ones that nail down what dogs want. Like, you can have all these other brands, and you can have Pets and Chewy and what have you. But if you want to have something special for your dog, you're going to think BarkBox. That's what they're trying to do. And so you can see, like, look, they're trying to, you know, I had showed this here, how they're constantly expanding their addressable market, you know, tapping into bigger and bigger markets by having new products. Oh, you want the Super Chewer for your big dogs. Oh, you want Bark Bright because, you know, a lot of dogs have dental problems after a few years. You got to brush twice a day, man. And then you have Bark Eats, like, hey, let's move into the eatery, you know, aspect of the market. This could be huge over time. So you constantly, you know, you start off with toys, then you move into dental hygiene, then you move into food, and you're just tapping into bigger and bigger markets. And so that's one of the points they make here is like, look, the dog food market is $25 billion for a company with a couple of hundred millions in sales. That's a huge potential. So if they succeed here, successfully gaining more and more share in the dog food market, then yes, the numbers alone would advocate that this could be, you know, multi-bagger from here. You know, 25 billion for a company with a couple hundred million in revenue. That does check the box of 10x potential. And I gotta say, I really like the fact that they're building this exclusive dog brand, this exclusive canine brand where it's like, hey, we got you covered for your very specific dog needs. You know, your dog is a big dog and likes to chew on really big things. We got that covered. Oh, we got these special, you know, dietary snacks. I like the direction that they're heading in. And keep in mind, it's not about boxing up someone else's brand. It's all their own branded stuff. So it results in better margins. You know, and so as they look at food, Bark Eats, you know, it's a combination of, hey, we need to look at personalized by a nutritionist, high quality kibble mix, portion controlled, but also have to make sure the dog's happy with the right flavor. And then, oh, the meals come with toys and fun features. So, this could be their advantage of, hey, they're selling these toys, they're selling the dog toys, and hey, maybe they come with free because they're already making a bunch with their food. The beloved Bark service layer makes feeding your dog a no-hassle fun experience. It's an interesting prospect. The challenge here is that they face lots of competition. And you could see here that they're effectively targeting basic or mass premium, which from a dollar spent perspective is like 90% of the market. But there are just dozens of brands out there. Pro Plan, Kibble and Bits, Gravy Train. That even almost sounds delicious for human food. I mean, every Thanksgiving I hop on board the Gravy Train. Hop on board the Gravy Train. Personally, stuffing is my favorite. Personally. So when I see this and I see all these major brands already in this space, it's going to be challenging. Like, yeah, you can tap into this big market, but what are you going to do that's going to set yourself apart? What are you going to do that's going to make you unrivaled? And that's the key filter I look at all prospective investments. Can they be unrivaled in this marketplace? That's a really tough one to answer. One way, potentially, is to have this sort of proprietary boxes approach where they just constantly license out new content, licensing with interesting partners, or coming up with specific themes for their boxes. They have Dogs Giving, once again playing into that Thanksgiving theme. That was weeks ago. Liquor Treat for Halloween, or Scooby Snacks. So which is great partnership right there. And they're coming up with other partnerships like, hey, maybe there's some sort of, college sports teams that would be interested in having their, specific Bark box. And they have. They've rolled that out. They also have Snowbound Hounds, toys specifically for dogs that are going to be in the snow and respective snacks. So they have many other unique brands, and they have a lot of sort of clever ways to sort of make them unique within the dog, marketplace. Saying like, how many other companies are so exclusively focused on dogs that you're going to create these brands or products that consumers love? 70 NPS score, Net Promoter Score, meaning about 70% of the folks are saying, hey, we would recommend this to another person, to another prospective consumer. So I would say their approach of creating this type of content definitely leaves the consumer very pleased. And in a competitive market, if you have a consumer that's delighted by your brand, there is that potential to tap into bigger and bigger opportunities. Let's dig into their financials here. So here are some of the key points that they call out. How fiscal year 21 to date, their new subscription growth is 2x what it was previously. So their subscriptions are on fire. They see record high 94.4% monthly product retention during the most recent period. Well, that's a really interesting point, and I want to flesh that out. The common phrase now is, let's double click it. I really don't like hearing people say that, but whatever. Let's double click it. They have a strong gross margin, of over 60%. Positive adjusted EBITDA during the fiscal year to date. They're saying that they're launching new products, and their new products are growing even faster, 179%, which could suggest that they're slowly building a platform which gives this sort of brand recognition where they can launch new products. Their new products get market acceptance, and then you sort of launch a new rocket. You have this, 179% growth from new product lines. And then they have 3.5 times increase in consumer cross-selling year over year. That's important because it's like, hey, you have the subscription, but maybe you want to get these add-on products as well. And the add-on products help with the margin of your subscription because that gets tied with the box that gets sent out. So the dollar that you spread on logistics costs is a lower percentage. And toys are generally higher margin as well. So each of these points are interesting, and I want to flesh out at least two of them. The first one is this 94.4% monthly retention. That just sounds fantastic. You're thinking, wow, this business is incredibly sticky. 94% repeat business. But wait a second. That's monthly. If you were to take that and look at it each month, 94%, then 94% of the 94%, then 94% of the 94%, you roll that out each month. What it really means is your cohort in this month 1, by month 12, the end of month 12, you're looking at 50% of what you started with. So 94%, that's a fancy way of them sort of masquerading that they actually have 50% churn. You could say 50% retention, but it's, half cup full, half cup empty. So you could say, yeah, you have a 99.9% hourly retention, something like that. It depends on your time frame. I personally think it's appropriate to look at this over a year. You're making an investment. What's your payback period? Questions like that, and we'll get into that in a second. Next up, this 60% margin is interesting. You look at Chewy, they're the dominant player in the United States, which is predominantly where BarkBox competes. And Chewy only has a gross margin of, let's say, 25 to 30%. So less than half of what BarkBox is doing. Now, sure, there's definitely a product mix difference. You've got cats, you've got, I presume, birds with Chewy as well. You have litter, and that's definitely, and then you also, so it's predominantly like litter and food versus the accessories, which are higher margin. That said, if you were to sort of try to balance all these things out, it would suggest, in my opinion, that BarkBox does sort of charge up a premium relative to Chewy. And it makes me wonder, is that a competitive risk longer term? Does Chewy sort of start pushing their own subscription and say, hey, this is way more affordable, and get it with your litter, or get it with your dog food that we're offering this box? Does that sort of squish them over time? And Chewy's a brand also that consumers generally love, growing very quickly. Given all this, does it even matter? That Chewy, has much lower margin, is growing quickly. Like, hey, 60% plus a high NPS score plus, 90% recurring revenue seems like a solid business model. Let's dig into that unit economics a bit. So first of all, the implied price is around $23 per subscription. They can, and that's based on this chart here where they talk about gross profit per subscription through 8 months. So you can split that up, and the gross margin's around 60%, so the price is around $23. But they show here, and this chart's really interesting, the customer acquisition costs through 8 months, which show that it costs them about $50, between $40 and $56 to acquire a customer. Now, here in fiscal 21, which is predominantly a COVID period, they probably have had this huge tailwind, which has resulted in much lower customer acquisition costs. So I wonder if this is actually the appropriate figure to use. People are probably going to them without them having to spend as much marketing dollars to get, that interest. That figure I cited earlier, 20% increase in households with dogs in response to COVID. So that probably is flowing through to here, in terms of how much does it cost to acquire those new subscribers. And, but as you look at this, even if it is, let's say, $50-$60, they are saying that, you look at the last few years, within 8 months, not even a full year, they've fully recouped that cost. And if you apply that revenue retention rate, and keep in mind that 94.4%, that's probably higher than average because, people are stuck inside and, hey, let's entertain their pet a little longer. But, using that figure, and using this $50, potentially, you're looking at a lifetime value to customer acquisition cost of 4 to 5 times, which is reasonably attractive. This isn't software where you own a customer for life, but if you lose 50% of your cohort your first year, they're still generating profits, admittedly greatly diminished profits, 3 to 4 years out. So, you're acquiring these customers for $50 and here's the gross profit, $108 8 months later. And you know what? Maybe it's still generating a fair amount in the months or even years ahead. It's going to be significantly less, but you're still going to be generating, an attractive lifetime value to customer acquisition cost based on what you see here. Now, if trends were to reverse because of COVID, where this goes from 40 to 70 and this goes from 108 to 84, then it's a little trickier. Then your payback period's a lot shorter, or a lot longer. Tricky to sort of suss out what's the difference between their organic business developments versus COVID. And here you could see their high-level financials, or their top-level financials, where they're expecting to be $369 million in revenue in fiscal 21, so ending March 21, and grow to $516 to $706 million. That is some impressive growth that they're penciling out. 30 to 40, 35% plus revenue growth in the years ahead. Now they are posting, really attractive growth, 60% plus in fiscal 21. Here's their gross profit, which remains at that 60% margin level, about 400 something of the 700 million in revenue that they're expecting a few years out. But they are pretty much expecting to be unprofitable, with adjusted EBITDA to remain marginally unprofitable. So not hugely unprofitable, not like they're burning hundreds of millions of dollars. And in all honesty, if you're about to do a SPAC and raise 420 million, it's not a big deal, in my opinion, to have this sort of burn. But it does make me wonder, well, wait a second. You're going from 200 million in size to 700, so 2 to 3x your size in just a few years, and you're still going to be operating at a loss. How come? How come you, what are the thoughts behind that scale? How do you get operational scale? Now, they do have this core adjusted EBITDA, and I believe that includes stock-based compensation and adding that back, but that is a real expense, stock-based compensation, so I say phooey booey on you. You dig into their financials, and you can see that they're penciling out. I don't like the way they did this. Let me call this outright. I like this, net revenue, cost of sales, gross profit margin, but I don't like the way they did this, which is SG&A, so sales, general, and administrative, and then marketing. Why couldn't they have done G&A and then sales and marketing? That said, SG&A is 40 to 45% of their revenue, and that's by and large what they've done in the last few years, as well as what they're penciling out in the years ahead. Here, I'll shrink my little screen. You can see here, but it's still 40, 45% of the revenue that they're expecting. And then you could see that they're doing about 18% of their revenue on marketing. So I'm sort of curious, how much of SG&A is, of SG&A is sales versus general administrative? There's a lot of sort of questions that it raises that I'll go into in an exclusive video following this. I sort of makes me wonder when I see this, 18% marketing. I don't know how much is spent on sales, but how much would you need to spend just to keep the business flat, given that 94% retention figure? And so you could see all in, you're still at a sizable loss, not that big, $30 million net loss, but net against a couple $100 million balance sheet, it's not a big deal. It's not like you need to issue capital. And if you're closer to profitable in fiscal 24 or 25, then great. You can self-finance in the years ahead. So this would suggest, they do have the cash to potentially get to profits in the years ahead. The big question is well, wait a second. How much do you need to be spending just to keep the business flat? Because that would suggest hey, that could be potentially what's your optimized margins longer term. And this was sort of my back of the envelope of saying, hey, what could be your margins, or how much could you pull back on sales and marketing. And keep in mind, I don't know that full number. I know they're spending 18% on marketing. I don't know how much they're spending on sales. But based on this, and let me walk through this, it would imply 12% of revenue needs to get spent on sales and marketing just to remain flat. And let's go through that. So month one, you get 100 customers. Okay? The average revenue per customer is $23, so you get $2,300 in revenue. Gross margin is 60%. This is all a back of the envelope for how to think about it. So you're getting about $1,400 in gross profit. But we know from the prior slides that their customer costs, the customer acquisition cost is somewhere between 40 and let's say $60. I'm putting $50 here. So 50 times, and that's, keep in mind, spending on Google, spending on Facebook, put those really cute dog ads and say, hey, get that bark box if you really love your dog. Guilt them into it. Enough successful Facebook ads and you spend $50 and hey, you get a new customer. So 50 times 100 is 5,000. So month one, you're unprofitable, but that makes sense. This is going to be repeat business that you're expecting. That's the core of this thesis. Will it be repeating in the future? And if it's at 94.4% from this month to the next, and it might be lower, 94.4 might be blended, but 94.4, let's just stick with that. That means your cohort of, let's say, 100 subs that you got in month one drops to 94 subs about. So to replace those 5 subs that you lost, well, it costs about $50. So that means it's around, that these 5-6 subs that you lost, it's going to cost you around $280 all in. So $280 as a percentage of the revenue that they were generating that prior month is about 12%. So just to keep the business flat, based on the figures that we see here, based on that revenue retention and that price point and the customer acquisition cost, we're saying, okay, this is about 12% of your revenue that you need to commit just to be flat in terms of the business. And that impacts what you think of their margins longer term. That said, as I mentioned a couple times, it's very unclear how much they are spending across both sales and marketing. Answering this has huge repercussions for how you value the company because, like when you're thinking about the long-term margins, if let's say they're currently spending 30% on sales and marketing, well, then you're like, well, at a minimum, that can go down to, let's say, 20%. You don't want to drop it to 12 because then you're flat. You do want a growth company. So, what's sort of the optimized margin structure where it could still be an attractive growth rate, still be profitable? You start playing around with these figures in terms of what you think it could be in the years ahead. You know that you're starting from 60% gross margin. You sort of have to work your way down, at a minimum, it's sales and marketing is, let's say, 10 to 15%. Okay, so now you're at 45%. And then let's say G&A and logistics costs, that might be another 15%, maybe a lot more. So that goes you from 45 to 30. So when you're thinking about the optimized margin, what this business could be long term, you're probably penciling out at most, on the high side, 30% operating margins in the future, on the high side. Let's keep going. So here is the valuation sheet. This is part of my value proposition to you, my loyal YouTube subscribers, in terms of thinking about this business, where I'm putting a range of 10 to 20% on what their operating margins could be. Currently, all that's available to trade are the units. So this is the stick units, but in the days ahead, it wouldn't surprise me if the stock starts trading as well and gets separated. It's interesting because this reflects the market environment where they effectively filed this SPAC within the last month or two, and they got a deal so fast that they hadn't yet separated out the stock yet, which is kind of funny because usually the stock and the warrants start publicly trading. A unit usually includes a stock and some sort of warrant that gives you a right to buy the stock at, let's say, a premium to the unit price. So the units are issued at 10, and the stock, The warrants give you a right to buy the stock at, let's say, $11.50 in this case. And so here, what I'm doing is this is sort of a ballpark because there actually isn't a market for the warrants at the time that I'm doing this. But $13 unit price, I'm assuming the per warrant value is $1.50. That might be too high. You could put in your own figure here. And then what's the implied share price? If you back out the unit amount. And so then it might be fractional warrants, in which case this should be a lot lower. So then you're looking at a share price of approximately, backing out some value from the from the warrants, of around $11.50 ballpark. And based on what they've said, that there's 200 million shares outstanding, a little over. So that gets you to a valuation of a little over $2 billion, which jives with what management called out. So I'm not backing out the cash here just because they are expected to burn, let's say, 100 million, maybe a little bit more in the coming years. And you can see that this is sort of the guidance figures that they gave were, 369 million in fiscal 21. I'm putting their guidance, I think they penciled out 515 million for fiscal 22. I'm putting that on the high end of the range for fiscal 22, putting 30 to 40% growth there. Using optimized margins of 10 to 20%. And that 10%, if you think, you think they're building out this incredible brand, then you'd say, look, Daniel, this 10% margin is just wrong. They should be 20 to 30% range. And that certainly does have an impact on how you think about this valuation. So then what's the growth rate in the 5 years ahead? Because I always like to look at things over a long-term time horizon. And so, I'm penciling out low side 15%. So once again, this is sort of saying, look, management doesn't deliver, versus 30%, which is much closer to what management is talking about. Management doesn't go out 5 years, but hey, why not? And then I put a wide range, 15 to 25 times earnings for this. And, you could see based on this range, and once again, this is my value proposition to you. You can download this sheet yourself. It's in the description of this video. You can play around with the assumptions. But based on management executing and delivering significant margin improvement in the years ahead, and assuming a full valuation of, let's say, 25 times earnings for 5 years out, and this is optimized earnings for what margins they could do, then you could see a stock that goes up over 200% over the next 5 years. Now, of course, look, this is my logical framework for how to look at things. A lot of YouTubers love to sort of send the nasty grams like, Daniel, your logic is pointless. We're living in a time where logic doesn't matter. Stocks just go up. Stonks. Gotta buy them. Look, how you live your life, that's on you. But I want a logical framework for me, for my personal journey. Because I like to sleep better at night, having some logic. This party that's going on, at some point, people will want logic. And when they do, I want to fall back on mine. But I hope the approach of like, hey, stonks go up, works for you. Bark is an interesting company. I see this and I'm penciling out over 200% on the upside, over 50% on the downside, over down 50% on the downside. It could be more on either going down or up. If they completely whiff on their growth projections, I would expect this to be a lot lower. It's an interesting company. They're attempting to build a very special, exclusively dog subscription brand. They're growing very fast this year. Over 60%, which is even faster than the category leader Chewy. That's more of like a pure play e-commerce play. Actually, it's not even pure play at this point. That's growing 45%. It's an interesting setup. I see this and I'm like, yeah, I could see how this works out in the years ahead. Like I could see them potentially really delivering on like dog lovers loving this. What am I going to do? Like, am I gonna be buying into this? Is this gonna become part of my journey to find potential multi-baggers? And I think you know what that answer is gonna be. For that answer, you need to go to Unrivaled Investing BarkBox.com, where I will post an exclusive video on BarkBox. Just following this, it'll be in the comments below where you can click on it, but that'll be part of the exclusive content for Journey subscribers. But that's just one of the perks that Journey subscribers get. Because what I try to add, what's my value proposition with unrivaledinvesting.com, go to Journey. What I'm trying to do is, one, an educational series to help investors on their journey. Two, I try to find potential multi-baggers each month. That's just part of my journey where it's like, hey, I'm looking for potential multi-baggers from my portfolio. If I'm finding them or finding potential ones, I'll let you know. Stocks that I think can go up hundreds of % over time. And then there's also the monthly update of what do I own in my portfolio, where you can see what I'm buying, selling, and holding each month. You can see everything. And you can see all my posts that I've done for unrivaledinvesting.com Journey by clicking on the catalog of contents. You got to click on that to see everything, where it's all the exclusive content, even in About Me. You can see my most recent portfolio updates. You can see the exclusive content here about BarkBox. So I'll be posting that shortly. It'll be in the comments below. And if you enjoyed this video talking about BarkBox, please make a point of subscribing. I appreciate your subscription or that thumbs up. And thank you so much for watching.